Friday, December 10th, 2021, Monaco 64, home of alternative economics and contrarian views. So today we're getting what is commonly called the inflation data or numbers. Why do I say commonly called? Well, because what we're really getting is the consumer price index, which is a measure of consumer prices that have been, of course, doctored with for the last 30 years or so to make those consumer price rises seem less than they really are. They've done it through substitution. They've done it through hedonics and many other things, I would say, that we don't know about. I recommend shadowstats.com. John Williams keeps a set of data. The way the government used to look at back in 1980, if the government looked at CPI like they did in 1980, it would be more like 15%, I would say. And as most of you know, most of you who have been watching me for years, and I always repeat that, and I won't tire of doing it. Some of you might get tired of hearing it. Some of you are probably just watching me for the first time. But inflation really is the creation of currency and credit out of thin air at a very high rate under a sound monetary system. It's the creation of currency and credit not backed by specie or gold and silver. Yes, the supply of gold and silver does grow, and it did grow under a sound money system. So if credit grew pretty much in line with the supply of money, there was no inflation. But if credit grew faster than the supply of money, real money, you could get some rising prices. And that's what inflation was. You've seen videos that I've made as well referencing a famous banker in Europe. He was very well respected in the first half of the 20th century. He was called Felix Sommeray, and in his memoirs, he said that only governments can create inflation in a fiat currency system, and he was right. So yeah, today everyone is waiting for this CPI number from the US for November. And I noticed that last week the expectation or the forecast was for, I think, a number around 7%. But right now, according to investing.com, the expectation or the forecast, and how do they get this forecast? Well, it's from different economists around Wall Street and the big banks in the markets. The forecast is 6.8, which is still very high. Last month, the October numbers came out at 6.2. They were forecast to come out at 5.8, so they were higher than expected. We'll have to see. But yesterday, the Federal Reserve published the financial accounts of the United States, the latest data. And that's all you have to look at. We're going to continue, unfortunately, to see rising prices, or if you want to call it inflation. I'm more comfortable with calling it the consequence of inflation. And why is that so important, the semantics? Well, because if you look at inflation as rising prices, you can blame businesses, shopkeepers, whatever, for the price, for the inflation, so to speak. It detracts attention away from the real culprits, which are the government and the central bank, who work together to inflate the system out of thin air. And it's a lot easier to do so in a fiat currency system because there's no limit, there's no gold anchor. So yeah, they publish these financial accounts, and you can see here that the growth in the federal debt, which is the government debt, which is inflation. The more government debt you create, the more currency you can create in a fiat currency system. The government debt is the flip side of the currency. In a sound money system, the currency is dependent on the amount of real money in the economy, gold and silver. Someone might say, oh, what if this country doesn't have any gold, doesn't have any gold mines? But that has nothing to do with it. It depends on how productive that country is, on how much trade it does with other countries. And in a sound money system, a country that is running a surplus is going to accumulate gold, and vice versa, a country that's running deficits. So that's why in the sound money system, the balance of trade is pretty balanced. You don't have countries like China and others like Germany running huge surpluses, and countries like the United States running huge deficits. But as you can see here, we had the largest government debt growth in the last 70 years. The data here goes back to 1952. So yeah, virtually 70 years we had the largest growth of government debt. I mean, it dwarfs what they did back in 2008 after the great financial crisis. And as you can see here, even dwarfs what they did back in the 70s and in the 60s. And the 60s was an era of the creation of the inflation because of the Vietnam War, because of the Great Society welfare state programs of Lyndon Johnson. But the price rises came in the 70s, and I would argue that the inflation really picked up after the great financial crisis with all the QE, the bailout of the banks. It's spiked even more. It's even crazier since last year during the pandemic, if you want to call it. As you can see here, government debt grew by 62.5%. In, I mean, which is crazy, of course. And I would argue we're getting already the effects of disinflation, which is being reflected in the CPI. And I would argue as well, we're getting the consequence of all the inflation we had prior to last year. All the QE, as you can see, that was enabled, that enabled the government to get more and more into debt. I think we're approaching 30 trillion. And the other thing that the government debt does, deficit spending, because government debt grows because there's deficit spending, and the deficit spending is very nefarious, even though Dick Cheney said deficits don't matter. Why is it nefarious? Well, because it gets, it kind of gives a false idea of the gross domestic product, because it's government spending is included in the GDP calculation. So if the debt, the government is spending more than it takes in, running deficits, it's going to show as a positive in the GDP. And if you look at the growth in the debt last year, 62.5%, that was just in the second quarter. You understand why they did that, because GDP would be still negative right now. We'd be in the depression. But what this does, it crowds out the private sector, and it disrupts the whole real economy. And why is that? Because governments don't work for their money, and governments take from the productive economy. So this is a massive massive event, in my opinion. Prices are going to continue to go higher. And the other thing I wanted to talk about is that earlier this year, yes, they were expecting the CPI to show high growth. And the excuse was that it was the base effect. Basically, the base effect means, if you look here at this chart, back in May and June last year, the CPI dropped massively towards zero because they shut down the economy. So they said, well, yes, we might see the CPI rise quite a bit in May and June of 2021, maybe July, but that's because of the base effect. We've come from zero, and anything after that looks big. Yeah, and I think that's why Powell had that transitory mantra or transitory narrative, which he's abandoned, of course. But as you can see, the base effect argument is gone out the window because the CPI has kept going up, right? So yes, unfortunately, it's going to get worse. The rising prices. Yes, some of you are frustrated that gold and silver hasn't performed as well in the last, well, year, or maybe even more than a year. But I've spoken about this. If you look at the 1970s, we had the consequence of inflation, rising prices throughout that decade. And gold and silver didn't go up in a straight line. And the other thing I would say, in an unhinged system like we've got, and what do I mean by unhinged? Well, is that they can't really raise rates. The Federal Reserve is cornered. I mean, what the Federal Reserve should be doing in the last 6 months is raising interest rates because we have runaway prices. They are going to lose control of the perception, or what they call inflation expectations. I think they're already doing so. And with that, let's look at the markets, and let's look at lumber again, because lumber earlier this year went through the roof, then it kind of corrected back down, and now though it's going back up. That's another sign that the consequence of all the inflation we've had in the last 13 years especially is here to stay, and that consequence is higher consumer prices. Of course, the Federal Reserve and the powers that be are trying to keep financial assets elevated. I think it's a complete joke that you have yields, bond yields below 2%, that you have the stock market at all-time highs, and you have even the unemployment rate running almost at 4%. You've got jobless claims running at a 52-year low, and yet the Federal Reserve finds it necessary to keep letting inflation run and prices run. It's crazy. They're going to lose control. The Fed is not hawkish. There are like, the Fed is a giant dove. That's what you need to understand. So, yeah, no end in sight. How is the market going to react today, especially gold and silver, to these numbers? I don't know in the short term. I have a feeling whatever the number comes out, even if it comes lower than expected, they're going to try to smash the paper prices. If it comes higher than expected, they're going to try to smash it because their excuse will be, wow, the Fed is going to be a lot more hawkish. They're not hawkish. They're only talking about decreasing the amount of money printing, or QE, that they're doing. But they should have started raising rates, I would say, back in August or September, and even maybe before, but they're not doing it. So it's 2 past 8 a.m., so 8 a.m. London time. We've got spot gold, 1773. It's down about $2. The CPI numbers, of course, they come out at 1:30 p.m. London or 8:30 a.m. Eastern time. The range has been 1782 to 1771, so we're near the lows here. Silver had a bad day yesterday, the paper price. And it's a little bit like what's happening in the health world, that we're being told that we need something like that every 3 months to be healthy. And what's that got to do with silver? Well, they're trying to tell us that, yeah, silver is rubbish, that silver is useless. Yeah, that's fine. I'm going to keep stacking. Same thing for gold. It's good when people say that gold is finished, gold is a rock, it's dead, like Michael Saylor comes to mind. Anyway, silver is down 12 cents this morning, or 0.5%, 21.83. Range has been 22.05 to 21.81. The Dow future is up 13. The Nasdaq is up 22. S&P futures up about 7 points. So market's slightly higher here. The FTSE is down 0.25% at 73.01. To the currencies, we'll start with sterling as usual. And before I go through the currencies, just announced that there was some GDP and economic data for the UK this morning. GDP came out lower than expected, 4.6% year on year for the third quarter. Was expected 6.6. Industrial production and manufacturing production all came out a lot lower than expected, even construction output. So the UK economy is not doing as well as people thought, and I don't think it's going to improve, especially with what the government is trying to do and mess about with people right now just before Christmas and this new Plan B. So back to the currencies then. Sterling hasn't really moved on the back of those numbers. We're at 132.12. It's down slightly. The euro is unchanged, 112.92. The dollar's up slightly versus the yen at 113.60. And the dollar is rebounded a little bit versus the yuan. We're at 637. To the other currencies, we've got Aussie dollar unchanged, 71.50. We've got the dollar unchanged as well versus the Canadian, 127.15. And the Kiwi dollar is down about 0.2% at 67.83. To the commodities, and we'll look at lumber first, just to show you how lumber is actually picked up massively. If you look at this chart here from last year, yes, we made an all-time high. When was it? Back in May this year, and then we saw a big drop. And it still dropped to a level that was almost double the level that it was last year during the crisis. And now it's picked up and it's gone back above this trend line. So it looks very bullish. What about crude oil, WTI? Well, that's trading around 71. It's up slightly this morning. High-grade copper is up 0.1% at 4.33. And natural gas is up 1.5% at 3.85. So let's just quickly look at the 10-year yield this morning, see where we are. It's at 150 or 151 really, 1.51%. It's up 2.2 basis points, a 1.5% yield on the 10-year when prices are rising almost at 7%. It's totally ridiculous, I would say, especially for those of us who started in these markets and financial markets back in the late 80s like me. I guess some young people who weren't around, haven't been around for that long, they don't see the absurdity of it all. Anyway, if you enjoyed this video, make sure you hit that like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.